Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, if you're already shell-shocked from relentless bad economic news, just don't watch any further. The data out of the world's largest economy is getting worse, as expected, but it is blowing by analysts' expectations, which had already been set very low. First, retail sales in March in the US were worse than feared, and February data was revised lower. February factory data wasn't flash, and March industrial production data was worse, both lower than analysts were expecting, and both before the real crisis hit. So it's no surprise that the New York Fed's business survey in the powerhouse Northeast region was grim, only that it was far grimmer than expected and far, far worse than what was recorded in the GFC. And the US Fed's Beige Book reported economic activity contracted sharply and abruptly across the whole country, with perhaps the New York report the worst. All districts reported loan demand was high from both companies accessing credit lines and households refinancing mortgages. In fact, the latest data shows mortgage applications up 7% in just 1 week as homeowners start to tap their equity to weather the crisis. That can only last as long as house prices hold, and they're unlikely given the huge surge in layoffs and joblessness. Unsurprisingly, all this data, much of it only for March, paints a picture of an economy under enormous stress. The snippets of April data already out paint a far worse picture. The Bank of Canada issued its latest monetary policy review and held its rate at 0.25%. They also announced a large money printing program to shore up both the federal bonds and provincial bond programs. And China has cut its one-year medium-term lending facility by 20 basis points to 2.95%, releasing $22 billion into their economy as extra banking system stimulus. China will release its first quarter 2020 GDP data later tomorrow, and it is expected to be very weak. The 6% year-on-year growth in the fourth quarter of last year is expected to turn into a 6% contraction in the first quarter of 2020. The policy responses at the same time will be closely watched. Iron ore prices are holding high in anticipation of massive Chinese stimulus announcements. China's actions probably can't save the world, but they will be important for both Australia and New Zealand. In Australia, the latest consumer sentiment survey shows a very sharp plunge, deeper than the GFC. Some key sectors like retail are pushing hard for official signals that they can reopen. However, one respected Aussie analyst, UBS, says Aussie house prices could fall by 10% or more, and the new housing starts could drop to levels not seen since the 1960s. The whole real estate market is in turmoil. Equities are down 2% in New York so far today. They were down more in Europe overnight and fell in Asia yesterday too. The NZX Capital Index rise of 2.5% yesterday was a complete outlier on the global stage. In money markets, the US Treasury 10-year yield has fallen to just 0.64% and a 10 basis points retreat from this time yesterday. Gold has moved back down today, down $16 to $1,721 an ounce. And US oil prices are softer again today at just on $20 a barrel. The Brent benchmark has dropped harder, down $1.50 to $28 a barrel. And that is after the US purchased 19 million barrels for their strategic reserve, an action which probably stopped the price from falling further. And the Kiwi dollar opens almost 1 cent lower today at 60 US cents. On the cross rates, we're unchanged at 94.7 Australian cents after yesterday's fall, while against the euro we're down another half cent to 55 euro cents. That means the trade weighted index will start today at 66 and wiping out all the rises over the past 2 weeks. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.